You know, you really can't escape the talk about artificial intelligence right now. It feels like we are right on the edge of a revolution that's going to change, well, everything. And according to some really interesting research from Vanguard, the economic hype, it's totally real. But they also point out this surprising twist. That massive economic boom could actually be a trap for investors piling into today's biggest tech stocks. So, let's unpack that paradox.
Okay, so first things first, let's start with what basically everyone agrees on. The consensus is that AI is about to just unleash this huge wave of investment and productivity. We're talking about something that could fundamentally reshape economic growth for years to come. And this isn't just hype, this is a genuine, transformative force in the making.
And this is where we get to the heart of it. If the AI economy is really set to boom, then shouldn't the companies leading the charge be the investment of a lifetime? Well, Vanguard's research suggests the answer is a lot more complicated, and frankly, it's pretty counterintuitive. To really get the trap, we first have to understand the bait. And wow, the bait here is an economic boom that could be truly historic. Let's just take a second to appreciate the sheer scale of the money that's pouring into this whole new era.
So who's driving all this? Well, Vanguard has this great term for them, AI scalers. And these are the giants we all know and talk about, right? Your Microsofts, your Googles, NVIDIA, and the entire ecosystem of companies building the hardware, the software, and the basic infrastructure that makes the AI revolution possible. They're the ones funding this massive transformation. And the amount of money they're spending it's just hard to get your head around. We are talking about a committed capital investment of $2.1 trillion through 2027. I mean, that figure is so huge it's almost abstract. This isn't just some trend, it's a tidal wave of cash that's retooling the entire economy.
And to put that number into perspective, just look at history. Other big tech revolutions, think railroads or telecom back in the 90s, they also had these intense investment cycles that peaked in about 5 years or so. By that measure, the AI cycle today, as massive as it feels, is still in its early innings. It suggests there's still a whole lot more room to grow.
And what's the payoff for all this spending? Vanguard thinks it could push U.S. real GDP growth all the way up to 3%. That's a rate that just blows past what most economists are forecasting. So the good news part of this story is really good news for the broader economy.
Okay, so the economy's set to boom. Case closed, right? Just buy the big AI stocks and ride the wave. Well, this is where the story takes a really sharp turn. Let's break down this paradox at the heart of the AI gold rush. This quote from Vanguard really gets right to it. They're saying they are super bullish on an AI-led economy, but at the same time, they're pretty cautious about the returns for the tech stocks that are leading the whole thing. So how can both of those things possibly be true? Well, it really boils down to this sharp contrast. On one hand, you've got all those incredible economic upsides we just talked about, but on the other side, you have some very specific risks for these top stocks. Sky-high valuations, the huge risk that their massive investments don't actually pay off, and the constant threat of being disrupted by someone new. And this really breaks down into two big hurdles. First, that $2.1 trillion investment, it's a massive gamble that could seriously crush profit margins. Second, and this is so important, is this idea of creative destruction. Think about it. The companies that built the railroads didn't always end up owning the future. New companies came along and used those railroads to create entirely new industries, and they became the real winners.
And that threat of disruption, it is very, very real. I mean, consider this statistic for a second. There are already almost 7,000 private AI startups out there with significant funding. That's more than all of the publicly traded companies in the US combined. Any one of them could be the next giant.
So if just piling into the biggest tech stocks is so risky, what's the alternative? This is where we shift gears from the problem to the solution. Vanguard actually proposes a playbook designed to capture the benefits of the broad AI transformation, not just a handful of the top stocks. And they point to 3 core opportunities that might actually surprise you. Number 1, high-quality U.S. bonds. Number 2, U.S. value-oriented stocks. And number 3, stocks from developed markets outside of the United States. Let's break down the logic for each of these.
Okay, first up, bonds. I know, this might seem a little weird in the middle of a tech boom, but the logic here is really solid. With interest rates where they are today, high-quality bonds are offering some really compelling returns above inflation. Plus, they act as a crucial diversifier, kind of like a safety net, if the AI boom doesn't quite pan out as expected. They're a stable anchor for a portfolio.
Now, let's talk stocks. The big idea here is to shift your focus from the builders of AI to the consumers of AI. You see, value stocks and international stocks don't have those same stretched-out valuations. And more importantly, sectors like industrials, financials, you name it, they are poised to use AI to become radically more efficient. They get all the benefits of the revolution without taking on all the massive risk of creating it.
So what does this all look like in practice? Okay, so here's a typical 60-40 stock and bond portfolio that a lot of investors use as a kind of benchmark. Just kind of keep this picture in your mind for a second.
Now let's compare that to the portfolio Vanguard recommends. You can see some pretty deliberate shifts here, right? Within U.S. stocks, there's a clear tilt away from those high-flying growth stocks and toward more stable value stocks. There's also a bigger slice dedicated to developed markets outside the U.S. This is the portfolio that's designed not to bet on the builders, but to benefit from the broad adoption of AI across the entire global economy.
All right, let's bring this all together. What is the single most important lesson to take away from this whole great AI paradox? Well, it's really about learning from the past so we can invest smarter in the future.
You know, history has shown us this pattern over and over again. The pioneers, the ones who build the brand new infrastructure, the railroad barons, the early internet companies, they are so often disrupted and just left behind. The true lasting rewards, they frequently go to the companies that figure out how to cleverly use that new infrastructure to build something completely new. Look, there is no question the AI revolution is here and it is going to be transformative. The real question for us as investors, and really for all of us, is to look beyond the obvious headlines and ask ourselves, who will be the true lasting winners? The builders or the businesses that they empower?